What if I told you there's a way to protect your stock position against huge losses without paying much for it and sometimes getting this position for free? In this video, I'm going to teach you a simple to execute option strategy that you can use to protect your shares from huge losses in the event of a market downturn. One of the best ways to guard against stock price declines is to purchase put options, but this strategy is expensive. A put option gives you the right, but not the obligation to sell 100 shares of stock at a predetermined price before a specific date. As the stock price falls, especially below the put's strike price, the put option will surge in value, which will offset the losses on your shares of stock. And let's look at an example to understand how that works. In this visual, we are looking at Tesla shares from late 2022 to early 2023. As Tesla's stock price collapses, the price of the 200 put rises multiple times over. If we add the put price to Tesla's stock price, we can see the combined position drops more slowly with a floor price of around $200, which is the put's strike price. That's because owning the 200 put option allows me to sell Tesla shares for $200 per share no matter what. And so that means that the combined position value of owning the shares and owning the 200 put cannot drop below a combined value of $200. However, consistently hedging with options is very expensive. Take Amazon, for example. Amazon is at $103, and the 46-day put option with a strike price of $95 is trading for $1.74. A trader could buy this put option for $174 and get exposure to a minimum sale price of $95 for 46 days. And this eliminates loss potential on the shares below $95. But paying $174 to protect a $10,300 stock position represents an insurance cost of 1.7% on the position's value. And this is only to protect the stock position for 46 days. That's a 14% annualized cost of insuring this stock position below $95, assuming we were able to enter similar put option positions every 46 days for the next year. And obviously, this expense is not sustainable because we'd need Amazon shares to go up 14% just to recover the cost of the put options, just to break even on the overall position. But don't worry, options traders have a more efficient way of protecting against stock price declines, which we will talk about right now. The strategy is known as the costless collar. To execute this, you must first own 100 shares of stock. Then you buy a put option and short one call option against each 100 shares for full coverage. You can buy the put and short the call in the same transaction to create the collar position. The premium that you collect from shorting the call option will offset or sometimes completely cover the cost that you pay for buying that put option to get that downside protection. Let's go back to the Amazon position to see how the collar can work in practice. In this image, we see the stock price is at $102 per share, and the 46-day 95 put costs $1.90. But the 110 call costs $1.75. A stock investor could buy the put for $190 and short the call for $175, reducing their net payment for the insurance to $15. This strategy fully protects the Amazon share position any price below $95 per share, which is the put's strike price. However, since we are shorting a call option against the shares as well, that would be limiting the upside potential above the short call strike price of $110. In this Amazon example, the collar is not truly costless as we are still paying $15 for it. We can adjust the strike prices of this Amazon collar to create a truly costless collar where we are collecting more premium from the short call than we are paying out for purchasing that put option. So for example, we could buy the 87 put and short the 115 call, receiving a total $10 in credit. This means that we are actually collecting money into our account when we enter these two option positions. Let's look at a visual comparing a stock price to a collar's position price. If we look at the prices of Tesla stock and the collar position consisting of the long 900 put and short 1100 call expiring in July 2022, we can see the collar position's value is much less volatile than owning the stock by itself. When Tesla shares ran up to $1,150, the collar position's value only got up to about $1,025. The maximum value of the collar position would be $1,100 or the strike price of the call. And that's because shorting the 1100 call means we give up all share upside above $1,100. But when Tesla shares dropped all the way below $750, the collar position's value never dropped below $900, and that's because the collar's minimum position value is the strike price of the put that we purchase. And that's because when we buy that put option, we are acquiring a contract that allows us to sell our shares at that put strike price no matter what. And that is the worst case scenario when you have a collar position. The benefit of using the collar strategy over simply using a stop loss on your shares is that if you use a stop loss on your shares, you are exiting your share position entirely when you get hit on that stop loss. If you get hit on that stop and then the stock price rallies higher, then you are not going to experience the recovery of your losses like you would with the collar position. If you have a collar position and the stock price drops below the put's strike price, you can continue holding the position through expiration, which means there's a chance that you can see the stock price go up and you will see your collar's position value increase, and you didn't get stopped out like you would by using a simple stop loss when holding shares of stock. The trading software used in this video is tastytrade, and for a limited time, you can receive up to $3,000 in funding bonuses when you open and fund your first tastytrade brokerage account. I would highly recommend tastytrade, especially if you are an options trader. So if you want to learn more, check out the link in the description below to secure that up to $3,000 in funding bonuses when you open and fund your first account with tastytrade.